There are things your lender knows that will never make it into the conversation because most buyers don't know how to ask and most lenders don't volunteer it until it's almost too late. Today, we're changing that. I'm back with Vincent Newsome, a home loan advisor from National Mortgage Funding based in Troy, for our fourth conversation together. We've talked about how mortgages work, we've talked about rates and what it really costs to wait, and we've talked about the medical professional home loans, which a lot of my clients are taking advantage of. And today, we're going deeper. We're covering what lenders are actually looking at when they decide to give you and how much, what it means if your income doesn't come from a traditional W-2 job, a money strategy most buyers are completely overlooking, and exactly what to do starting today if you want to be ready to buy in the next 12 months. Whether you're a first-time buyer or you've done this before, I promise there's something in this conversation you haven't heard yet. Let's get into it. So let's welcome back Vincent. Hey, Vincent, it's great to have you.
Thanks for having me.
I can't believe this is our fourth time doing these segments. So happy that you're here and ready to dive in.
Awesome.
Let's start with something that affects every buyer regardless of the price point, and that's how the lender actually evaluates you, because the number the bank is willing to lend you and the number you should actually borrow are not always the same thing. So Vincent, can you explain what the debt-to-income ratio is and how it determines what someone can actually borrow, not just what the bank will approve them for?
Great question. One we do get often, as you can imagine. With a debt to income ratio, what that is, that's a monthly debt divided by monthly income, and that percentage allows us to qualify you for certain loan programs. Each loan program has a different percentage that it allows us to go up to. So let's say you make $100,000. On $100,000, you're making about, let's say, $8,300 a month. Again, we're looking at monthly debt, or monthly income, I should say. When we divide that with your monthly debt, that doesn't really matter what your balance is, but what your obligated monthly payment is. Not what you pay, but what you're required to pay. So with that, if you, let's say you have an $8,300 you're making a month, and your debt's, let's say, $4,000 a month, roughly you're looking at a 50% debt to income ratio. We want to stay at 50% or lower to being conventional. Now, for government programs such as VA or FHA, those do allow us to go to higher debt to income ratios. So with VA, typically we want to keep you under 56% along with FHA as well. VA does allow us to go a little bit higher than 56%, but now we have to talk about different factors that come into play to make your loan go approved. All in all, we want to make sure that we keep debt to income 50% or less, not only for the qualifying standpoint, but also to make sure that you're comfortable. What I can qualify you for and what you're comfortable paying are two different scenarios, and that's something we're going to discuss together when we go through your application.
Nicely done. I want to spend some time on a buyer profile that comes up a lot in the $250,000 range, and that's the buyer whose income doesn't fit neatly into a W-2. Business owners, contractors, people who are commissioned, because the process looks very different for them, and a lot of them don't realize that until they're already under contract. For someone who's self-employed or has irregular income, like a business owner or a 1099 contractor, how does the loan qualification process work differently for them?
I deal with self-employed clients a lot, and there are different requirements for different loan programs that we are allowed to do when we're looking at tax returns. Whether you're 1099 or you're self-employed, the requirements are the same. With self-employment, we need typically a 2-year history for tax returns. Now, what that means, if you're an S Corp, a C Corp, or even a Schedule C, which typically would be if you were 1099, we need to look at federal returns for 2 years. If you do have an S Corp or a C Corp, or even a partnership, we do need to see business returns as well, also on a 2-year scale. If you've owned that business or you've had your Schedule C open for more than 5 years, with conventional programs, we can get away with using your last year returns. Why is that beneficial for you? Well, when it comes down to 2 years of returns or 1 year, 2 years we do have to average. If you have a higher return for that last year, then we can use your higher income amount and not have to average you out for 2 years. Again, that's only if we're going conventional and only if you've had the business open for 5 years or longer. Now, if we get into VA and FHA, that 5-year rule doesn't apply. We still need to look at a 2-year history of self-employment. Now, the one thing question I get a lot with self-employed clients is, well, Vince, I have an S corporation. I have a W-2. I'm not technically self-employed. If you have more than 25% ownership into that business, we do see you as self-employed, whether you issue yourself a W-2 or not. At the end of the day, once we look at your returns, I'll be able to calculate everything out. There are items on your tax returns, which we don't need to get into today, but I can go back and write it back into your income, even if you're writing it off. So there are certain things that we can see other than your bottom line that we can improve your income with. Long story short is, once you're ready to apply for a loan, I will ask for that documents ahead of time before we issue out a pre-approval to make sure that everything will run smooth on the process and the income portion isn't a concern.
Vincent, before we started rolling, you mentioned seller concessions, and I'm glad you brought it up because this is something I think buyers are leaving money on the table with, especially right now. So let's talk about it. Walk us through what seller concessions are, how they actually work with a loan, and how a buyer can use them strategically in today's Metro Detroit market.
We're seeing a lot of seller concessions right now on offers, whether that be on the initial purchase agreement or after inspection with negotiations. Seller concessions, what those are, is the seller is giving money to the buyer from the proceeds that they would get from the sale of their home. So if you're buying a $250,000 house and you're giving back $5,000 in concessions, the seller is going to be walking away with $245,000 as their purchase price. There are different requirements that the buyer has to meet in order to get certain percentages of seller concessions. So if you're putting 3% down, let's say on a conventional loan, the most seller concessions that you're able to get is also 3%. If you're putting 10% down on a conventional loan, the most seller concessions you're able to get is 6% of the purchase price. Now, if you're putting 25% down, the most seller concessions you're able to get off of that would be 9%. So different levels of down payment allows you to get different levels of seller concessions off of your purchase price towards closing costs, towards your escrows, which includes your property taxes and your homeowner's insurance. Now, that's conventional. FHA and VA, they have different requirements. FHA, you are able to get 6% seller concessions, regardless of how much money you put down. That can be beneficial if you are tight on a down payment amount and you don't have enough for the down payment or to cover your closing costs, I should say, then that will allow you to go up to 6% to cover your closing costs. With FHA, you still have to pay the down payment amount from your proceeds. So the concessions cannot cover down payment and closing costs. It's only able to cover the closing cost section. As to VA, you're able to get 4% as a maximum, regardless of how much money you put down. So there are different requirements on different loan types and different down payment amounts, as you can tell. With that being said, that is a great tool for a buyer in order to alleviate some of the down payment proceeds to keep more cash in pocket for home repairs or for maybe your taxes, property taxes, or your homeowner's insurance to balance that section out.
I want to close out the conversation with something I think every single person watching can use, whether you're buying in 6 weeks or a year out and you're still figuring out your plan. If someone came to you today and said, I want to buy in 12 months, what should they be doing right now to put them in the strongest possible position?
Setting yourself up to purchase a home is the best thing that you can do. There's a certain things that you want to look for. Your credit score. You want to make sure that your credit score is in a good position. Your debt to income. Make sure that you don't have a ton of outstanding monthly debts. And assets. That's the one I see a lot. A lot of the times we do see clients fit both buckets of credit's great, debt to income's fine, but we didn't save enough for the actual down payment amount. There's certain things you need to think about with the down payment. So you had the principal portion of it, and then you have the title work, the origination for the underwriting, the property taxes, your homeowner's insurance. So there are other factors other than the actual principal down payment amount that you have to keep in mind while you're saving. Now, with that being said, I always encourage buyers to come to me regardless if ready or not, but you are really thinking about purchasing. That way we can take a look at your full picture to see where you need to be and lay out the right plan for you to make sure that when you are ready to purchase, that we've covered all the boxes. So that the financial requirements, obviously that's what we need to do to qualify you. Now, as to you, we want to make sure that you're comfortable as well financially to have a new mortgage or a new debt on your monthly expenses, which again, we'll go over scenarios to make sure that the payments that we're estimating is comfortable for you. Now, if your credit score, let's say, isn't where you want it to be, there are a couple things you can keep in mind to try to increase that credit score by the time, 12 months hit. What we want to do is you want to keep your high limit balances as low as possible. So if your high limit is, let's say, $2,000 on a credit card, we want to make sure that you're keeping your balance on your monthly statement maybe closer to like 500, 250, and not max it out to a $2,000 expense for that monthly statement. That will definitely help on your credit score, and especially if you're doing that with multiple trade lines. The other thing too is that we want to make sure that, again, you are comfortable when you're purchasing the house. So we will look at your total expense, what you think is going to be happening maybe even the next 12 months as well. We can manually add that in to make sure we're calculating out not only the right debt to income for the mortgage qualifying, but again, to make sure that you're comfortable and you know your why of why you're buying the house.
So that's 4 conversations with Vincent now, and honestly, every single one has given me something new to think about, which tells you everything about how much goes into the process that most buyers never see. Vincent, if they don't know by now, can you tell our friends watching where they can find you?
So you can find me on Facebook, my name, Vincent Newsome. You can also email me at vincentnewsome@nmfunding.com or call me at 248-388-5528.
Thanks again for another great talk. I hope to see you soon.
Thank you for having me.
My pleasure. So, if you're buying a home in Metro Detroit or you're planning to, I want to put something in your hands that makes the whole process less overwhelming. I put together a free home buyer's guide specifically for this market. It walks you through every step from a very first conversation with the lender to actually what happens on closing day. It's linked right below this video. Download it, save it, and share it with someone who's thinking about making a move. And if you have any questions about any of this, about a specific neighborhood, about whether now is the right time for your situation, reach out. That's what I'm here for. I'm Leslie Martin. I look forward to helping you make your next move.